72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Okay, a lot to talk about today. Oil continues, to hurt the market. Now, we're going to talk also today about 401ks. People are really getting crushed. They're taking money out of these 401ks left and right. And, the problem is Wall Street, they're not there to help you. They don't give good advice. That's number one. There's so many people today that are buying on the dip, thinking that tech stocks are going to go back up. And all these TV jibber jabbers are telling everybody, go in and start buying on a dip, buy NVIDIA, buy all these stocks on the dip, they're going to go back up. Well, it's going to be a long time before they go back up, but they won't tell the truth why. Okay? And there's 5 reasons they're not going to go back up, because, or for at least for a long period of time. One, yields must stop spiking intraday. If they don't stop spiking intraday, then yields are got to go back to 4% or under that, about 3.75, in order that we get a tech rally. But that's one of the big problems right now, is that yields keep spiking during the day. They got to settle down. They got to be stable. The other problem is that inflation is not going to retreat. You need it to retreat. That's another big problem they have. And how's it going to retreat when we got this war? And I think it's going to be much longer than anyone anticipates. But anyways, regardless of that, inflation, it's got to retreat. That's another big problem. That's not happening. Oil prices. Now, that's another big one. Now, oil prices are outpacing our GDP growth. They got to fix that. And the big one is that if you take the spiders and the Qs, while they're holding, IWM, the small mid-cap stocks, is dropping. That's a disaster. So again, those 5 items right there have to be fixed before tech stocks go up. What happens is the investors, we call tourist investors, don't know what they're doing. They see the stocks going up. You know the ones, NVIDIA, Meta. They start going up and they don't think, wait a minute, they're going up because of short covering. They're not going up because of growth. So then they start jumping in. I better buy on a dip. I better buy on a dip before I lose out. Don't buy on a dip. You're going to get crushed. The only people who do well are the institutions. That's why we follow them. They're the smart money. When the tourist investor starts buying on the dip, it creates these little rallies. And the institutions, the smart money, they'll go in and they start selling into those rallies, sell into the rallies. They wait back, and in the weeds, all of a sudden, boom, starts rallying. And because you got people jumping in, buying on the dip, institutions start grabbing the profits, putting in their pocket. So, no, there's a big issue with these tech stocks. You've got to stop buying them, or you're going to really get hit real hard, And the other thing is that we have stagflation. That's what everybody should be talking about, but few are. Wall Street's masking what's going on. We have a strong message of stagflation, and that's the worst thing you want to have. And so stagflation occurs when you have oil going up like we have, and you have yields going up. Now, the big problem is when people see yields going up, Wall Street has taken parking space in their head where they believe, oh, yields are going up. that means things are great. Wages are going up. Everything's going up. Everything's going to be perfect. We got wages going up. We got costs going down. No, not at all. So what's happening is when we got oil going up and we got yields going up, they're going up for the very wrong reasons. And people think, hey, I better jump in and buy because yields are up, good times are coming, when it's just the opposite. So that's another thing that's killing the market. And also, remember, there's only the good news with stagflation, there's 4 areas that do well. There's 4 groups out of the 11 sectors. Energy is one of them. Miners, especially steel and copper, those do very well. So we also have another problem that's going on in the market nobody wants to talk about. The liquidity, the fuel that drives the market, is drying up. Boy, you don't want that to happen. You don't want that to happen, but that's what's going on. What drives the market is liquidity. Liquidity is that when institutions, they have all the money. They have $17 trillion. And when they want to buy stocks, they put that money through channels like pipelines. So one pipeline is going to tech, another pipeline is going to banks. So they'll push that money through. But that money's got to go through smooth. You got to go through it smooth and speedy. And what does that is the liquidity. Remember, liquidity is not cash. It's the ability to push the money through smoothly and quickly. And when that stops happening, then you got a problem. We're starting to see that happen as well. So you got to be aware of that. So we got stagflation. It's becoming very real. The longer they keep this war going, the longer prices go up with oil, and the longer inflation's a risk, the higher these yields are going to go up for the wrong reasons, and that will crush this economy, and this will take this market down for a real big crash. So they got to get this war over very early, okay? But it's not happening. Now, again, remember what's going on is Wall Street's good with all the storytelling. And they'll continue to tell stories to keep you buying. And you just got to learn, no, you got to close your ears to these people because everything they're telling you is fundamentals and they don't work. Now, also what's going on, and no one wants to talk about, is the 401k. The 401k is becoming, the people are doing withdrawals on these 401ks, and that is that's becoming a disaster. And if the 401k, you can't withdraw. Doing withdrawals just kill you, and that's one of the biggest problems we have today. Is the 401k, because we got all these emergency withdrawals. And we haven't seen this kind of withdrawals in years. Now remember, the 401k is a failed experiment to begin with. They don't work. The only people who make money on 401ks is the company you work for and the mutual fund companies that sell them the garbage that goes inside your 401k. Now, remember, your 401k mutual fund charges too much. That's why it can't work. They charge between 0.5% and 1%. But the spiders only charge 0.09, okay? So that's a big hit to your 401k. Now the balances, we keep hearing how the balances are up. 401ks, historic balances, are up 11% this year. Play the cut where they're telling everybody's rich.
Yeah, we're really much in a Goldilocks economy. Growth was holding up remarkably well. Inflation was actually coming down in the US, albeit relatively slowly. We're expecting Fed rate cuts. Earnings are holding up. So this is a pretty good environment, in our opinion, for...
But the joke is a very good environment. How can it be a good environment? When balances are up 11%, that's great. The average balance is about $446,000. You're not going to get far on that. But the withdrawals, they don't say that. When you hear people come on, look at the 401k balances, they're up big time. But wait a minute, let's talk about the withdrawals. So And let's talk about the fact that you got housing and medical care and driving 67% of these hardship withdrawals. And these hardship withdrawals have more than doubled since 2018. And hardship withdrawals jumped from 2% in 2018 to 6% where we are now. That's a 200% increase. So how can they say, this guy just said, everything's wonderful? It's not. So again, stop buying on dips. Now, the biggest reason for all these withdrawals, people are fearful. They're trying to stop foreclosures, evictions. They're trying to pay medical bills. That's the big thing, is medical bills. God, they got to find a way in this country to help people with medical bills. The emergency 401k, yeah, the withdrawals are, they don't say this. They say, boy, we're up 140,000. That's wonderful. But they don't talk about the emergency withdrawals are an all-time high. And even 40% of households who are earning $300,000 are working paycheck to paycheck, living paycheck to paycheck. What are you, nuts? Now, the average balance is about $167,000. That's the highest ever. But the withdrawals, hardship withdrawals, are the highest ever. And what they're saying, the people doing the withdrawals, is layoffs are surging. They're getting laid off. They don't talk about that on CNBC or Fox, or they don't talk about it. Credit card delinquencies have a 13-year high. I mean, are you kidding me? What a contradiction to Americans are richer than ever. What a bunch of BS that is. The only people doing well is the top 1%. I should say top 10%. I'll give you that. Now, workers are living paycheck to paycheck, despite these high 401ks. So they're using these withdrawals as a safety net. You're not supposed to use your 401k as a safety net. It's supposed to be your retirement. This is terrible what's going on. Now, what triggers, the top triggers, 36% is to avoid foreclosure or eviction. Have you heard that from anybody? No. Another trigger, 31% is for medical bills. Have you heard that from anybody? No. The problem is people got complacent with their 401k. They got blind. They think their 401k is set and forget. Don't have to do a thing. But you got to understand, one of the biggest reasons that 401ks only return on average 3 to 5% is because unlike a pension, okay, the reason they get such lousy returns is because of their own behavior, the decisions they make with their 401k. If they just stayed out of that 401k and made the right decisions, they'd make a lot more money. But they're their worst own enemy. They always buy at the high, right? Get out at the low. They make terrible, terrible decisions. And that's one reason why the 401k is not doing as well as it should be doing. So the bottom line is this, that the stock market right now, as long as oil keeps going up, inflation worries are going to be here, and inflation worries are here, the bond market people want higher yields. That's the killer. That's the killer. So you got to learn how to sell short. If you're buying on the dips, which a lot of people are doing, you're going to get slaughtered. You're going to get slaughtered. It's just terrible. You got to stop. That buying on a dip is a joke. The only people making money on the dip, buying on a dip, are the institutions. There's 13 institutions, and every time you buy in the dip, the price goes up. They're in there selling their stock. Wall Street's making money. Institutions are making money. You're not making money. That's the problem. So as I said, if you take the spiders versus the 401k, you're always better with the spiders. You make an average of about 10% a year. Now, you'd be doing okay with a 401k. You'd probably be making 5 to 7%, but you're making 3 to 5% because, again, the hidden fees kill you, the turnover costs kill you, the share fees kill you, the wrap fees kill you, revenue shares kill you. Just a lousy deal. Okay, let's fix it. Join my gang. See you on the charts.
Are you nuts?